So I'll just quickly get straight into it. My outline is very simple tonight. I'm just going to give you my little philosophy, sort of my general overview or beliefs when it comes to managing risk and how critically important it is to trading, and whereabouts along the journey and the path we actually finally begin to appreciate, in fact, how important it is. And then, of course, I'd like to spend a lot of time in MetaStock tonight. Obviously, my time is limited, and I won't be giving a 3-hour MetaStock session, but I certainly will go in, and I've just had a bit of a scan, a bit of play around this afternoon. The ASX is struggling right now, so not a lot of long opportunities, but certainly quite a few shorts popping up. And certainly the purpose of tonight is not to provide recommendations, but it just means there are a few opportunities being presented to us so we can discuss them and talk about the practical application of managing risk. And I think, as I said, I think it cannot be overstated how critically important risk management is. Well, what I've decided to do is just for the first little bit of, I do have that sort of 55 minutes tonight. What I thought I'd do is just start off by providing you a very quick sort of overview of where I place managing risk into perspective of the whole picture. I don't think this will be news to a lot of you, just to give you my philosophy and my beliefs, and I'll share with you some of my beliefs very shortly and how they apply to managing risk. But again, I just want to put everything into perspective. And most people know that when we start trading, well, if you're like me, when I started, I thought trading would be quite easy money. And then it took a little while before I realized that it was actually going to be quite difficult, easy money to make, and probably the hardest easy money there is. And somewhere along the journey, and I am really quite confident that everybody travels along the same path, along the same journey. We're just at different stages of that path. And one of the things that I realized is really early on, we come to this appreciation of how important managing of risk is and managing our money, and not so much where we identify trading opportunities and how we go about doing that, but once what we actually do once we're in the trade. And again, the earlier we realize that and appreciate, the better off we'll be, and the better off we can put in steps to manage that as well as we can. So again, this particular slide here, I'm not stating anything new, but again, just to emphasize the importance of developing a plan that absolutely is right for you and resonates with you and suits you and your personality and the like, but of course, just as importantly, implementing and executing that plan with all the right skills and attributes that make good traders, things like decisiveness and discipline and patience and the like. But of course, managing money is a component of that. Certainly the mindset, the 6 inches in between your ears, is the glue that keeps it all together. But just if I come here, just to break it all down to what a trading plan really is. And interestingly, I think, again, when we first start out and hear about a trading plan, we think it's designed to get us into trades and have us trading. And I actually look at your trading plan being a slightly different tool with a slightly different purpose. And again, I think it's counterintuitive. I believe your trading plan is not designed to give you trades and present opportunities that come across your screen or your desk. I think your trading plan is designed to actually keep you out of the market. Your trading plan is designed to routinely and constantly say no to potential trading opportunities. And only those that meet the strict criterion that you develop and you create should be presented to you as potential valid setups or opportunities. So routinely, and if you think about the ASX, and maybe you just limit yourself to 500 stocks, even just the top 200, routinely your plan is saying no to 199 of those, or 195, or what have you. So generally speaking, your plan is doing a more defensive, protective role than actually letting opportunities in. That's again just my view of what your trading plan is designed to do. And again, it really just boils down to managing your money and only ensuring your money, which you worked hard for and saved up and put into a trading account, goes to the best opportunities that have the greatest probability of actually delivering you a positive outcome. I think your money deserves that, and not to just be willy-nilly, indiscriminately just thrown at the market hoping something sticks. So when it boils down to, and again, this is nothing new here, when it comes down to, your trading plan should answer 3 questions. How do you get into trades? How do you size that trade? Where do you put your stop and what have you, and how do you size that trade? And then under what conditions will you exit? And of course, that's a 2-pronged question relating to both at a loss and of course also in a profitable situation. And when you think about this and just dig down a little bit deeper, that's the order in which things logically happen. But when you try to rearrange them and identify what's most critical, then we actually get a completely different order. And we now get what conditions will you exit, both a loss and a profit being critically important. Almost as important as that is how much money you risk. And then in a distant third place, to use a horse racing analogy, as it's Spring Carnival coming up soon, just ahead of the ambulance, right down the other end of the straight, is under what conditions will we enter the trade. So again, when we start out, that's not obvious, and it's counterintuitive to think that the opposite end of the trade is the most critical component. But again, I'm sure everybody in the audience tonight, they know this, but I'm just trying to reaffirm or reassert that what we do with regards to managing our money and managing our risk is paramount. It's of critical importance, just to provide that focusing back. So when you look at the importance list down the bottom, the first two listed there, to me, both relate to managing of risk. How do you get out of trades, and how do you determine size of trades? And it's those two things tonight that I'm going to really focus on. And I'm going to show you in MetaStock how we can do that. And it all ties into the beliefs and my philosophy on trading, which I'm about to share with you very, very shortly. You may or may not know, with the GoToWebinar platform that we do use for these webinars, in your little control panel that would have opened up when you logged in, you have access to a questions area. And in fact, some of you have already used that prior to the session starting. Please feel free at any time to open and access that questions area and type a message away, which will be delivered directly to me on my screen right in front of me here. I will do my very best to respond to that and answer that during the course of the session. So I really, really encourage you to engage with me and get me involved, and certainly ask any questions about anything that I've spoken about tonight. Well, some of my beliefs, again, just a little bit of my philosophy and sort of what, the way I see trading, and certainly just, what I've seen from coaching a lot of people over the years, and certainly having met a lot of fellow traders over the years and spoken to them and heard some of their struggles and what have you. These are some of my beliefs. But more importantly, and I will very quickly talk about each of these, more importantly, I think most of these have an application when it comes to managing of risk. Most of them have an application. Trading is a process. I'll explain that in just a moment. To me, trading, and done well, is a rules-based activity. Rules-based process. We do the same things over and over and over again. We have systems. Systems make us efficient. We get good rules in place, very clear-cut, clearly defined, and we apply those and implement those on a routine basis, on a consistent basis. That to me is what good trading is all about. That is why I still use MetaStock 16 years after I bought my first version back in 1999, because some of the things that I'll show you tonight greatly assist with having that consistency. And again, I hope that becomes a little bit more obvious when I speak about that shortly. The less is more is not perhaps related to managing risk directly, but my philosophy with that is the fact that I believe, just anecdotally and what observations I've made, I think traders are far better off by trading less. Now, brokers will not sell you that idea because they generate revenue from you trading and your activity and you trading more. But I think for your trading success and your longevity and your chances of actually achieving some consistently successful performance, I think trading less is far better for your trading health. Now, again, I think that's a bit counterintuitive. I think when you think about trading at a very raw level, you think about giving yourselves opportunities to make money, and you do that by opening up trades. And intuitively, you think the more trades you open up, the more opportunities you have to make money. That makes a lot of sense. But I really do believe that trading less is better for you. Only demanding the highest quality signals is better for you and better for your trading health. And I probably won't say any more about that, but that's certainly a very strongly held view that I have. Something a little bit more related to managing risk is I think your very best trades take time. They take time. So there's an element of patience required, but more importantly than that, there's real reliance on having a very mechanical system or model to manage your exits. So I'll talk about trailing exits very, very shortly, and I'll show you the one that I've used since about 2001 and still use to this day. Can you believe that? And I'll share that with you and just explain how all that works. And because it's been around for so long, it may not be news to a lot of you, but that helps having a very structured way of managing a profitable trade, and it makes it very, very easy to allow it to continue to run and to give it every opportunity to become one of your best trades. And I'll talk about that a little bit later on. Not use things in isolation is a little bit more related to your entries. I cannot overstate simplicity and keeping it simple. And whenever I sign one of my books, Trading in a Nutshell, 4th edition, whenever I sign it on the inside cover, I always write those 3 words just above my signature, and that is just keep it simple. It's counterintuitive, I think, to think about simplicity in trading. We start out thinking probably trading's easy money. We then realise it's not so easy. We then go along a path and a journey of learning indicators and trying to really complicate and make quite complex our trading solution and our strategy, where in actual fact I think very good trading strategies are very, very simple. And again, I'll try to share that with you a little bit in this session this evening. And then finally, having, depending on how you pronounce it, data or data-driven decisions. Businesses use this all the time. They're always collating information. They talk about BI, business intelligence, and they talk about collating information or data about everything, and then making decisions based on that. It makes for very cold, unemotional decision making based on just pure facts, based on pure information. And I think as traders, we can take a lot from that and apply that to our trading. And again, that's one of the things that I love about MetaStock, is that it's data-driven. It relies on OHLCV information for every security or every product. And what we do is, excuse me, what we do is, basically apply ones and zeros. We apply very clear-cut, defined rules to the data, to OHLCV. One of the things that I'll share with you, which has become quite relevant just recently, if someone to go to MetaStock for the first time tonight, and I don't want to show you that particular chart there, I'll just go to the ASX 200, which of course is Australia's general index, 200 or so. I'm just waiting for that to come through on your screen there. I'll just remove the commentary there. This is a chart, current chart daily of the ASX 200, the broad brush index for the ASX. And at the top there is a very, very simple tool that I use, and I actually share this on my blog quite routinely. And I can even show you the formula. I'm not prepared to do that right this second, but the formula is actually quite straightforward. It's just my volatility percentage indicator. And this is where I talk about having simple things that allow you to make data-driven decisions. That particular indicator at the top is measuring the volatility percentage of X. Whatever X is, whatever's on the chart, and at the moment it's an index, it's the ASX 200. So this can be used as a visual thing where you literally have it on a chart like that. It can make a determination about whatever that indicator is presenting to you, but of course in MetaStock it can be used in a number of other tools, including the Explorer, which I do use it for that, to filter out securities that actually are not volatile enough and those that are way too volatile. But as an example, one of the things that I've done from my testing is found that indices generally move between 0.5% a day and 1.5% a day. And in fact, up the top here, I've got 1.5% drawn there as that black line. You can see though for the last few weeks, and this is quite typical of all or major global indices at the moment, you'll see that that red line has in fact breached a threshold, has gone above a parameter that I have set myself. Now I've set that myself simply through observations and validation and testing. I could have easily made it 1.48. I just chose to make it 1.5, but you can see that it's moved beyond the last few weeks, beyond that threshold. In fact, it's done that for the first time in 4 years. So it really does show me that the index, therefore the general market, has moved into almost irrational, silly territory. And we're getting back almost to 2008 where this particular indicator moved to in excess of 4%. And that's an average, that's just not one day, that's consistently achieving those sort of levels. And of course, volatility is directionless, doesn't go up or down, it's just movement. So all this is saying is the market at the moment is a little bit irrational. Some may apply this as a rule so far as managing risk. They know because of this, there is a chance, it is feasible, that there is a little bit more risk associated with trading ASX equities, because generally the market is a little bit more volatile than it generally is. And perhaps I have a number of options. I either sit out, I reduce my trading frequency, I reduce my trade size by a particular amount. We have a number of options, but what we are doing in any event is recognizing the market and what it's doing, and we are making data-driven decisions. So there's no emotion associated with this, it's very cold and objective, and I'm simply allowing the price and the information to drive a decision, which is important to me so far as my managing risk is concerned. So that's just one of a number of tools that I have that, you know, a lot of these things I don't plot on a chart unless I want to, but they're actually doing work for me in the background so far as explorations, and that's probably the main tool that I use in MetaStock is the exploration to go and find securities out of 500 as an example. So that's just one example. I'll show you a few more that are really data-driven. Again, nothing emotional. I'm not applying any interpretation to that. It's just a simple threshold that's been broken, and therefore it's indicating something to me. Just give me a second. Anyway, that's just one example of you know, something being driven by information. And again, just a reminder, I've seen a couple of questions coming in. I'll do my very best to get to those. But again, if you have any questions at any time, please don't hesitate to ask. You have the little questions thing there in the control panel. That's your best way of contacting me during the session. And I know Hunter will probably remind me at the end if there's a few questions there that have not been responded to. Okay, let's move on a little bit more. I need to move on a little bit and talk a little bit more, and then I want to get into MetaStock. Just quickly, this is process. This is, to me, a logical step-by-step process that even those, you know, who are trading a little bit, but certainly for those who are really trying to find their feet, this provides a very much a framework, a logical step-by-step process that traders routinely follow. And as you can see, a lot of them do relate to managing a risk, determining initial stop, position sizing, and how we're actually going to get out of trades is all part of that. Even step one, going to assess where our current positions are and seeing if we need to move anything in our platform, our trading platform, in our diary, whatever sort of form that takes. But that to me is a logical step-by-step process. Excuse me. But again, just provide some framework. Okay, I need to move on. And I've decided by the end of the hour, I really need to get off all this and start showing you a few things in MetaStock. So that's the task I've set myself. And knowing how much I love to waffle, that's going to be difficult for me. One of my favorite quotes when it comes to managing risk is this: don't focus on making money, focus on protecting what you have. Now, I think the majority of people who start trading, their primary motivation is money. Okay, absolutely pure and simple. There might be secondary motivators, but it really does boil down to having that freedom associated with money. And interestingly enough, our focus is very much on money. And I think one of the great ironies of trading is it's because we focus so much on the making of money that actually has us routinely making very poor trading decisions which result in us losing money. It's ironic, it's unfortunate, but that's the reality and the way it is. Now, our North American visitors won't perhaps appreciate this as much, but again, a quote I can apply to this is Steve Waugh, the former Australian Test cricket captain, was once asked, what was the best advice you were given in your cricketing career? And he said, well, that's simple. The best advice I was given was don't get out. So Steve Waugh could rewrite this and say, don't focus on making runs, focus on protecting your wicket. Right? Of course, making runs is important, but you cannot make runs if you're dismissed. This guy is saying the same. Yes, of course, making money is important, but if you don't have any money to trade with, you cannot. So actually protecting what you have, all this is doing is making you adopt a very different posture when it comes to money. Rather than being optimistic and really excited and so motivated to make money, we adopt a very defensive, conservative posture when it comes to making money. Okay, moving on. Notwithstanding the psychology side of things, definitely the decisions we make related to managing risk are the most critical. A very poor entry, a totally random throw a dart at a dartboard entry can be saved by a good exit. We could, not that I would buy the Australian dollar right now, but if we were to buy, I don't think that would be a good entry, but we can easily save that by just having a really good exit in place. Having said that, a wonderful, fantastic, well-tested entry for all the right reasons, high probability, can be completely stuffed up by a poor exit. Okay, so it doesn't work both ways. The exit is everything. A good exit can save a poor entry, but a horrible exit can completely stuff up the very best entry you have all year. I'll talk about 8228 in just a sec. And really, I know trading is a mental game, but when it comes down to decision making, it really is a numbers game. It comes down to strike rate, percentage of winners, percentage of losers, your average profit, your average loss. You throw them into a mixing bowl and hopefully have a positive number come out. At the end of the day, that's what it is. It's all numbers. So when people trade currencies or other things, they talk about profit targets, reward to risk relationships. That all comes down to controlling the numbers and making sure the numbers are in our favour, just like a casino does. Okay, moving on, a few more hypotheticals. I've got 5 minutes and I need to get into MetaStock for you. Again, pretty straightforward. You've probably seen something like this before. It just really, certainly for those with limited experience, it really pushes the point home hard that the number of winning trades you have is almost irrelevant. It's what happens when you win and what happens when you lose. So very quick here, 10 simulated trades. You started with 20,000. You had 8 winners, all generating a 10% profit. Only 2 losers, but both generated a 50% loss. After 10 trades, despite an 80% strike rate, you are lucky to have half your money. Okay, so again, just you can invert that, invert the scale, have only 2 winners, but being really good. So again, it's just a numbers game. You can do 19 trades really, really, really well and do all the right things, and the 20th trade you can completely stuff up by getting ahead of yourself, not managing the exit well, thinking it'll come back tomorrow, all those reasons that we clutch at to stay into trades. And the 20th trade can completely undo all the good work you've had in those 19 trades. It almost doesn't seem fair. You think you need a string of bad trades to undo all the work, but one can do it. And if you've traded as much as a lot of people have, I'm sure that's happened to you on more than one occasion. So again, just the strike rate thing. William Eckhart, known as the one of the turtle traders originators, along with Richard Dennis, said, the desire to maximise the number of winning trades or minimise the number of losing works against you. The success rate of trades is the least important performance statistic. So don't focus on strike rate too much. Furthermore, when we do have that, really big loss, which we need to completely eliminate from our game, if we continue to take small profits and don't allow good trades to take time and let them run their course, it can take a lot of time to repair the damage. So a bit more on expectancy, and then we need to get into the software. Despite our sort of initial thoughts on this, strike rate is not as important as we think it is. And if I was to say, someone says, I get this often, someone who's got limited trading experience, what's your percentage of winning trades, what's your strike rate? And I'll say 43.5%. They're almost the scoff. That's ridiculous. That's hopeless almost. Is it that important? I think 43% is pretty good. I think 50% is really good, and I think 60% is almost like fantastic. And 80% is next to impossible. So we sort of need to rethink the way we view strike rate and percentage of winning trades and what have you. It is a numbers game. It's what happens, of course, when you win and when you lose. Okay, moving on. And finally, just to emphasise, Ed Sekoda, one of those traders interviewed in the Market Wizards book. I love his elements here of good trading. There's only 3 of them, and you can read those 3 there. The elements of good trading are, there's the 3, and he says at the bottom, if you can follow these 3. That quote, it just really echoes the view and the sentiment of all those traders interviewed in the Market Wizards book and how much they focus on managing risk and, of course, taking care of their bad trades. And another one of my favourite quotes, in fact, I think I have it at the end, is, the most important thing in making money has nothing to do with your profitable trades. It has everything to do with your losing trades. Again, that doesn't make any sense. You don't think that's the way it is. You think making money, the important thing is what happens with your profitable trades, but it's not. It's what happens with your losing trades. Okay, let's get into a little bit more practical here. So I'm going to talk about question number 2 in the trading plan, and that's position sizing. Determining, how many will I trade, how many units, contracts, lots, shares, CFDs, whatever it might be. And I think this is a really critical component of managing the overall sort of, here's my trading capital, I need to break it into pieces and make sure I manage that well. You'll commonly refer or hear the 2% rule, never wanting to risk more than 2% of your capital on an individual trade. I really do think it's the type of trading you undertake and the products you trade is probably, that can vary a little bit. FX, I think, is a little bit different because you generally don't have a portfolio of a whole lot of currency positions, but in stocks or equity CFDs, you might in fact do that. And of course, it is a very important part of managing your capital and allocating capital to individual trades and doing that in a very responsible manner. My formula is very simple. Again, this is nothing new to a lot of people. Importantly, and coming back to my point of consistency and process and taking emotion out of decision making, this is something you can easily, maybe not so easily, you can set up in MetaStock, and it is very much a part of, in fact, I've just seen a question here about this particular point. Obviously someone who's purchased my add-on. This is a part of the altitude trading system where these calculations are done for you, and I will show you that a little bit. it's more to highlight how you can make things easier for yourself by having these things being data driven and having these things laid out for you, rather than you trying to guess or try to, oh, I feel good about this, or having any sort of emotion involved. My formula is very simple, and that is the number of we're going to trade is equal to the risk divided by DTS, which is your distance to stop. And if you're trading something where there's a currency risk, for example, currencies, you would then need to include another component, another factor, and that is your exposure per pip and how that relates. Now, when it comes to shares and just trading stocks in your particular currency, that is not as much of an issue. So what I've got here is a simple example, very, very straightforward. So what I'm going to do here is I'm going to go to the MetaStock again and just show you one that I just looked at a little bit earlier. This has come up on my scans a few times. It's been a pretty good performing stock, and that is this one here, which some of you may have physically been to, and that's Sydney Airport, ASX code SYD, I think. So here's an example where this is doing everything I want it to do. You know, there's the trend ribbon down the bottom, clearly indicating very strong long trend. I only want to buy it, I don't want to sell it, and it may have generated an opportunity for me to purchase. So what I might actually do here is, you know, determine, excuse me, that I'm just going to put my stop down here somewhere. I don't want to focus too much on stops, because a lot of risk management sessions do that. I want to focus more on the managing of position sizing, but also the trailing exits as well. And if we have a bit of time at the end, I'll come back to stops. But I find that's what people focus on first and focus on the most. So I might determine that, you know, it's currently a bit up about 6. I might have a stop down here at 560, 550, 540, somewhere down here. And just coming back to my presentation, I'm now going to start to populate this formula. And I think I've worked out that I'm going to have a stop at 40 cents away. So just looking at this formula now the number of shares I'm going to trade. Now this is assuming no leverage, no margin. This is just straight out purchase of stock. I've determined, based on my trading capital or what have you, that I'm prepared to risk $500 every single time I take a trade. Right now, based on my trading capital, my X% rule allows me to risk $500 when I open a trade. So the first component is the risk, which is 500, and the DTS is the distance to stop. And it's 0.4 because the 500 is in dollars, and the 0.4 is also in dollars because it's 40 cents. And then it just becomes a simple calculation. Then we get the answer of 1250. When we put the 1250 and the $6 stock, we then realise we're now potentially having a position of $7,500. Another rule we can apply, and again this is in the position sizing calculator of the expert advisor I have, is it will then say, right, is this within certain parameters of your overall capital? So the $500 is all well and good, that's X% of your capital, but does the $7,500 exceed a particular threshold or percentage of your overall capital? For example, if my trading capital was $12,000, there is no way I would be purchasing 1,250 stocks at $6 at $7.5 grand. No way in the world, because it's well over 50% of my whole capital in one particular trade. I just wouldn't do that. If I had a capital of $50,000, I'd be a lot more comfortable and okay with committing $7,500 in that particular case. Now, whilst this seems a very, very simple formula, I cannot stress how powerful a formula it is. And I guess it comes back to my simplicity is actually quite effective and does work well in trading. And this is a very simple formula. I cannot stress how powerful it is in being able to manage your exposure and manage your capital for individual trades. It is a wonderful formula that I've used a lot and just placed a huge amount of importance on this. It sounds a little bit pedantic at times. You think, oh, well, I'm allowed to trade 10,000 with something else. Why don't I trade 10,000 with this and do 10,000 divided by 6 and work out how many I can purchase? I just think if we want to do this well and be the most methodical, disciplined, structured, organised trader we can be, then simple things like this matter. And attention to detail matters. Attention to detail means we do things very well in a very professional manner. Just coming back to this here, I think the expert advisor is already on. Now the number is going to be slightly different here because I've set different parameters, what have you, but this is an example of This is an example of how you can have data-driven decisions. You can have all of your conditions and rules and parameters set up, and you can do this in an Excel spreadsheet if you really wanted to. And would you believe, back in 2000, that's exactly how I first started doing all this, was in an Excel spreadsheet, inputting a few variables, and the cells would calculate it all out. And I had it really nicely formatted with different colors and all this sort of stuff. And I probably still have a copy of that somewhere lying around. Can you believe that? That's how I started, and now it's got to this level, and I've had this set up for quite some time now. So there's a lot of data, there's a lot of information being presented. It may or may not influence my decision to purchase. A few of the things in the exploration do, and the columns of information that are in there, but having information like this which says, okay, assuming we're going to get in at the current price, and based on the other conditions you're giving me, this is your position sizing for this particular trade. It makes it very unemotional, very clinical, and one of your very important trading decisions that needs to be made is made very, very clinically, and it's made for you. So it's a very simple formula, this one back here, but I really believe that it's a very, very powerful formula, and it's a very important part of you managing your risk and managing your exposure and managing your capital. Just coming back to here a little bit, just by the way, just showing you in here, it's in here somewhere. This particular indicator, hopefully that comes up on your screen okay. It allows you to obviously modify all these settings, so it's just a lot of inputs in here. There's a lot of hypotheticals here for me here for tonight. Input all that, and then it does the calculations down below, and all that feeds. And this is what MetaStock can do for you, and that's why I love the software, and I've been using it for so long. So it allows for that customization, allows for you to make some very clinical decisions. And when you have confidence in what's being inputted, confidence in the testing and the validation and what sort of, excuse me, what's driving those decisions, having then software with ones and zeros drive them for you, or an Excel spreadsheet or whatever it might be, I think is incredibly valuable. Anyway, that's just my take on that. I'm happy to talk position sizing a little bit more, and I have noticed there are a few questions coming through, which is, excuse me, they're actually starting to come through a bit thick and fast, which is a great thing, I guess, which is great that you're engaging with me and getting involved. I'll do my best to come back to those. I'm sure Hunter will remind me at the end. I just want to talk a little bit more, again, from a practical standpoint with the trailing exits as opposed to focusing on stops. One of my beliefs I mentioned at the beginning is that your best trades take time. And one of the things I often do in a seminar, and I did this at a conference in Sanctuary Cove not so long ago, and I did a scan at the top, using MetaStock, of course, did a scan of the ASX, and I found all the stocks that have achieved a more than 100% gain in the last 12 months. All of the stocks more than 100% gain. And, excuse me, it actually produced a huge number of stocks, most of which I'd never heard of before. I then broke it down into columns using the exploration, and I identified those that achieved from 100 to 200% gain, 2 to 300, 3 to 400, and 400 plus. Would you believe there were some stocks that have moved more than 400%? And one of the common questions, and this was the real point of what I was trying to teach, one of the common questions from that is, Stuart, that's wonderful. How do you find those stocks? How do you find stocks that are going to move that far? And that's a very obvious question, and everybody's thinking it. And here's my point, and here's a really important point. That's the wrong question. The answer to that is you have no idea. You cannot find them. When you buy something, you have really zero idea where it's going to go. We know about probability and our expectations, but we really don't know. So the reality is you don't find them because you don't know. What you do focus on is what you do should you be lucky enough to find one. That's the key, and that should be the focus, and that comes back to managing risk. So if you are fortunate enough to find a stock and get into one of those that moves that far, how do you ensure that in 6 months' time, 9 or 12 months' time, you are still in that trade and you are enjoying every single bit of gain that we've just explored and found over the last 12 months? How do you put yourself in a position where you are still in that trade? And this is why it comes down, what mechanism, what tool, what indicator, what sort of process can we put in place to ensure that we give that stock every opportunity to continue to run? This is the beauty of trailing exits. And the other question is, how do we adopt the mental state? How do we adopt the right attitude and approach and the patience and the discipline to make sure we stay in a trade that long to enjoy that particular trade? And when it drops down a few days in a row, where it's so easy for us to go, right, that's it, it's up 47%, I'm happy, I'm out. No. How do we ensure we don't do that? How do we ensure we have very simple rules in place that allow us to enjoy that and continue to run and have the discipline and the patience? So that is really the more important question, as opposed to how do you find them. So just on trailing exits, I just want to share with you a few things here, and I'll talk about how altitude and ignition differ greatly in this particular sense. I really do believe in letting profits run. I don't think that's as applicable with currencies and a few other products, but with stocks, you know, they can get on runs, and I think sometimes you can have a trade which just makes your year, just one trade. And you may have 37 for the year and just one takes care of business for you. There are a number of different ways in which we can have trailing exits and the like, but I think a really good way is just the ATR model, which I did a lot of testing on some time ago. I have actually just quickly prepared, I've actually got it already on the chart here. I've just been a little bit sneaky by changing its color for you, just in the interests of time. So this is what it looks like, and again, it's probably something that a lot of people have seen before, where it's just, you know, again, I probably wouldn't have opened down here somewhere, but just to simulate and give you an idea of what a trailing ATR looks like. And I mentioned this at this Sanctuary Cove event not so long ago, and I brought my children into it, can you believe that? And my youngest daughter is 8 years old, and I said to them, I said, my daughter, if I gave her a 30-second rundown of what that red line is designed to do, she could every day come in and look at all my charts and tell me whether I needed to take action or not. She could come in and say, right, you need to do something with this one. I don't know what it is or what the stock does, but you need to do something, or NFA, no further action. So on a daily basis, you open up your portfolio, you come in and look, is the price above or below the line? It's that simple. My 8-year-old daughter can do that. Yet, I don't believe there's a more important decision we make than when we get out of trades, and certainly those that are working out well for us. And having a process in place, again, I cannot stress enough how powerful something as simple as this is, because it's very clinical. It is really just a piece of software with some red and green things on a chart and a red line. And if I think about it in those terms, this can be a very simple decision to make. And when I see price like that, and I should disclose I'm not in this particular stock, but when I see, you know, a situation like that, price doing this, red line below, it's NFA. It's that simple. It takes 3 seconds for me to draw that conclusion. Just another thing with testing that I've done, of course, you can see here that it has in fact pierced the red line and then certainly rallied back up and traded above. And I also often get the question, what do you do? What happens when the price breaks through but then closes back up? Are you already out? Do you have, and I heard someone explaining to me a hard stop and a soft stop, something I've never heard of before. I always wait for end of day close. I have seen far too often prices pierce through and break through my trailing ATR line only to just rally back and finish well above the red line. I've seen it way too many times. What I think is important, again in the interests of consistency, is you always do it the same way. So if you choose to have a stop set on that red line and your trading platform without your knowledge just goes ahead and executes that exit, then that's fine. But I think what's important is you do it that way every single time and don't chase your tail constantly changing back and forth. But if you do it like I do it, again, I think that's fine, but I think we should do it that way every single time. Now the payoff for me is the fact that I stay in more trades. The downside is that when I do get stopped out and I see it and have to get out the next morning, the damage is therefore potentially greater. But now sometimes it gets back up and I'll get out at in fact a higher price, but sometimes of course it does in fact gap down on open and I get down at, exit at an even lower price than I had anticipated. But that's trading, that's just the way it goes, and I'm prepared to cop that because I think just through my testing and observations that I made, personally I'm far better off waiting, and that's just a decision I'm very, very comfortable with. As simple as it sounds, and I have another example here with Ramsey, which I have enjoyed owning Ramsey a lot of late, and it's done very, very well for me. And in fact, I've been on Your Money, Your Call a few times and stated that in public that I've had some good times of this and owned this a few times. But even a simple thing, as simple as it sounds, and that's my trailing ATR again in action, as simple as it sounds, a moving average can do a similar job. So I can just put on here a 50-day moving average, as simple as that is. When something moves well, moves in a very healthy trend, and I'll get rid of my line there, get rid of my trailing ATR indicator. Even just something as simple as that does a good job. Now, if you are looking to trade like my altitude system, which is a little bit more medium term and looking for trends over months as opposed to 1 week, which is what Ignition does, then you are prepared to sit back, the trailing exit, sit back and allow that stock every opportunity to move back and forward, and so have you. You wouldn't do that with Ignition, but you would with something more medium term and a little bit more conservative with this. And I think that's important, that we do in fact sit back and allow it to do its thing. Because we know even in the strongest of uptrends, you do not get 400 green candles in a row. It is littered with red candles and reliefs and just little sort of, selling and what have you. But even something as simple as that can be a very effective trailing stop. It really can. But again, do your own homework. You do your own research and validate that and prove it or disprove it. But that's something that I think can, as simple as that is, and I think you can do it better, I should concede, but even something as simple as that, I think can work. Just a simple, moving average can do that as well. I think one of the things, just coming back to Sydney Airport, I've got a few other examples to show there as well. A few things that I just on stops, managing risk, and again, a common problem that I see people making all the time is not that they don't set stops. They don't initially, then they learn, oh, I really need to protect myself here a bit, and everyone's telling me to set stops. Intuitively, what a lot of people early on do is set their stops way too close to the price. That's why I love ATR, because it measures volatility of X, whatever X might be, and then tailors your exit to that particular product, to that X, whatever that stock is. But it's a very common problem. Intuitively, it's, look, I really need to set my stop close because I don't want to lose lots of money. That makes a lot of sense. It's intuitive to think that. And yet when we come back to a simple model like this, we then realise that, I'm just going to get fancy here and draw a little bit, we then realise that as this increases in value, therefore the distance to our stop increases, the number of units or the number of shares we're going to purchase simply decreases. But we are still managing this and ensuring that we only risk what we are prepared to risk. And this is a really critical component of this formula. It's don't be afraid of having a wide stop. As obvious as it is, clearly the longer, further away your stop is, the less chance you have of being stopped out. The payoff is, the premium you pay, so to speak, the cost to you, is the fact that if this trade does work out well, you don't have as large a trade as someone who had a tighter stop, theoretically. Having said that, the person with a much tighter stop took far greater risk initially than you did because their stop was so much closer. That's why I love something like an average true range indicator. As simple as this is, and I'll just apply it over the chart here, as simple as something like this is, it just tells you all the time, what the sort of average movement is. At the moment for this, it's 11 cents or so. So I can use that information, and the last thing we'll do is set a stop less than 11 cents away from the current price. Just really high chance, and the next day I'll be stopped out. And I'm hoping to still own this in 3 months. Not just 3 hours. So, where we set stops is obviously important, but not being afraid of having a wide stop is really, really important, I think. But again, that's counterintuitive. It doesn't make a lot of sense. It's, no, put your stop a long way away. Whoa, no, I don't want to do that. I'm going to lose more and more money. No. You're obviously not thinking about position sizing well. You don't have a simple model which does all that for you and helps you, sort of mitigate that and sort of manage all that for you. Anyway, that's my idea on trailing exits, 20 past the hour. I'll just get on really quickly and finish off a few things, and then perhaps any time I have left, perhaps I can quickly look at some questions here, or hand back to Hunter, or go back into the software a little bit. Again, one of my favourite quotes, the most important thing in making money has nothing to do with your profitable trades. It has everything to do with your losing trades. Just to wrap up here, perhaps before I answer some questions and look at the software, again, I'm stating some obvious things here. The risk is not avoidable. You just have to do everything in your power and be the most professional discipline you can be in putting everything in place and making it easy for you to manage that exposure and manage your risk. The risk averse and risk seeking, there's a little simple experiment I do, a little exercise I often do in this particular session. It doesn't work well over a webinar, but it involves marbles. Some of you may have seen me deliver it before. It involves probabilities and pulling out marbles and winning money and losing money and what have you. And it really just highlights and emphasizes how intuitive it is for us to become risk averse when faced with a positive outcome, risk averse, but very risk seeking when we are faced with a losing outcome. And when it comes to losing trades, we should be doing everything else but becoming risk seeking. We don't want to become risk seeking. We want to manage that risk, avoid it, get out of the trade and move on. But it's very intuitive for us to become risk seeking, which means it's very intuitive and instinctive and very easy for us to adopt more risk, hold on to losing trades, see what happens tomorrow, just wait a little bit longer, or worse still, you know, allocate more money to the trade and try to double down or dollar cost, whatever people do to do that, which I think is just crazy, but people do it obviously. So that's that risk-seeking, risk-averse. Do everything you can to protect, preserve capital, put steps in place, make it easy for yourself to do this. The reality is, if you want to do this as well as you can, when it comes to decision making, everything to do with managing risk is everything. It really is. Now, I'm all for high probability entries and getting into trends and doing all those sorts of things, but at the end of the day, it's purely a numbers game. It's how well you manage the exits with regards to profitable trades and losing trades. Definitely set stops. Think about trailing exits. Think about patience being, you know, having a very simple process to manage all that. Very quickly, Hunter might mention this as well. Some of you, based on your questions, obviously already have my add-on. It has the altitude, which is the more conservative medium-term approach. It has the ignition trading system, which I haven't shown you at all tonight, which is a lot shorter term. Has a whole lot of indicators. It actually has a reversals system as well. That's just a quick summary. I don't want to spend too much time on this. Medium-term, wide stops, a lot tighter stops with regards to ignition, and heaps of other indicators, including that volatility percentage, a sentiment indicator, which I publish often on my blog, which I look at indices and what have you. Again, just coming back to my beliefs and relaying this back to risk management, consistency for me is one of the really keys to good trading. You know, confidence, comfort in the risk, in the level of risk you're taking, but consistency in everything you do. And this is a shameless plug for MetaStock. This is why I love MetaStock so much, because it allows me to be consistent. I remember my mum used to say to me, "What do you think of Woolworths? What do you think of BHP at the moment?" And I'd be going, "I have no idea. Like, I haven't looked at the chart of Woolworths in ages." And she'd go, "What are you talking about? I thought you do shares and you do stocks and all this sort of stuff. Why can't you tell me?" I said, "Because I haven't looked at a chart of it in ages. Unless MetaStock presents it to me, I don't waste my time looking at it." And that's the way I view my trading. And that's the thing about having systems, whether it be software or what have you, but ensuring efficiency and only doing what you have to do, and having things work for you, like the Explorer, or having the expert advisor and all the commentary and all those sorts of things. So I'm a big one for consistency, and I really can't overstate that. I do believe trading less is better for you. I believe your best trades will take time. Every now and again, may not ever happen where you have a really good trade just overnight. Does all the good things for you, but that rarely happens. Absolutely believe in simplicity and what have you, and I certainly believe in data driving decisions. Good businesses do it. They look at business intelligence and the like, and I think we can adopt that with trading as well. That's my email address. You're more than welcome to email me. That's my MetaStock partner page, so to speak, my reseller page, where I offer a newsletter and try to help people use MetaStock to its full potential. That's my add-on the box, and there, as Hunter mentioned earlier on, in a couple of weeks, tomorrow, in fact, I'm off to Salt Lake City, which I'm just thrilled to be speaking at a MetaStock conference again. I've done it before, and I'm really excited about seeing all the guys in a couple of weeks at their conference over that weekend. Just coming back to the software real quick, I don't have long. I will show you quickly an example that came up. Here's a few examples. Excuse the black. Hopefully it's a bit easier on the eyes, perhaps. I just did a quick few scans earlier this afternoon, and I did it, of course, not wanting to take up time in the webinar, but here's an example of an ignition system. Not as much in the commentary, it's really just highlighting what it's looking for, etc., etc. There's a few others here, and of course they're all highlighted. But with this, with stops, none of those lines there are the stops. With stop, they're just going to be a little bit tighter because we're looking to trade much smaller trends, much smaller movements. And just coming back to Ramsey as an example, what we're looking to do, with altitude is hold on to things for a lot longer. But when it comes to, oops, just lost my drawer then. When it comes to ignition, we're really just looking to trade small moves like this. Hopefully you can see that little blue line there. That's all we're really looking to do with ignition, just trade really short-term trends. Therefore, your stop's going to be a lot smaller, et cetera, et cetera. And we always do that in alignment with the longer-term trend. Okay, just quickly read through some questions here, and then maybe in a minute or two I'll hand back to Hunter, and then I'll very much thank you for your attendance tonight. It's been just thrilled to have the opportunity to speak to you. I'm thrilled with the response and also humbled with the number of registrations and the number of attendees this evening, which is terrific. First question, do you calculate portfolio value for position sizing at the end of each month or more frequently? It's a really, really good question. It's not something I actively do. I don't know if it's out of laziness or not, or just wanting to strive for simplicity. I am certainly aware, because in MetaStock you have a layout and you just have them all there. So I think you are routinely aware of where you are currently sitting, where you're at, as opposed to me doing it mechanically and having a number spat out at me. So it's not something I do. Having said that, I think there is value in it, and just because I don't do it doesn't mean you shouldn't, because I think it's quite valid. What I try not to do is to make things too complicated. And I saw someone present to me about a month ago. They had an index, they had an indicator on it. When it dropped through a particular level, they had to sort of basically close all their positions because they were too exposed. And I personally totally disagreed with that. I thought that was just too complicated. That was too, I just didn't like that. I thought trades should be allowed to run their course, and if they're going to get you stopped out, then they're going to stop you out. So that's just the way I view of that. With $50,000 capital you spend now on stock, how do you do it on trade? Use CFTs? Leverage? Can you make the example too? That's a really, really good point. I think it changes a little bit when you are involving leverage, and the reality is that to open up a trade of 10,000, you may only have to put up $200 or $500 to do that. The reality is you are exposed to a trade size worth $10,000, even though you are theoretically only putting up $200 or $500. So I really do believe you need to think about full exposure as opposed to what has physically come out of your account. What that ends up meaning is that you may be fully committed, but you've only got 15% of your capital being used, but theoretically you are fully committed. So I think CFD changes a little bit, leverage changes a little bit, but it's a great question, and I'm really glad you're thinking about that. Do you use a system test or another method to test the rules of your systems? I certainly initially did a lot of testing. I actually did it manually because I had the time and I wanted to see the results bar by bar, candle by candle myself. I had the time to do that, so that was fortunate. Interestingly enough, it was an unintended consequence. I actually learned a lot about technical analysis doing it that way. That was not what I set out to do, but I actually learned a lot about TA doing it that way. One of the things I'll say about system testing is I don't believe we should take every single signal that's presented. I think we are better than that to be able to apply and identify. So my scan might spit out 12 results. I think it did with this shorts for ignition today. I'm not going to trade all 12. What I need to do is arrange those to say, look, there's the top 3. I'm prepared to take 2. There's my output today. The system tester doesn't do that. It takes all 12, and I don't think that's fair, and I don't think that's practical. So, yeah, I've done a lot of testing in the past, but not so much recently. Okay, it's 28 past. I really need to probably just wind up then. Again, just a quickly thrilled with the response. Thank you so much for your time. I need to take a breath now because I don't think I have for about 5 minutes, but I was so excited to talk to you and share some of the things that I do with you tonight. So terrific, thank you very much for your time. I really appreciate it, and I'm sure we'll hang around a little bit to answer any questions. Appreciate it. Hunter, I think that's all yours if you are still there.
I am. Wonderful presentation, Stuart. As always, it's a pleasure to be able to host these events for you. A couple of things that I did want to note here is I am a firm believer that simplicity is incredibly crucial. establishing guidelines, establishing rules that you are able to follow consistently is very, very, very important. And in the business development department, which is what I primarily handle for MetaStock, I see a lot of different systems and a lot of different ways to accomplish similar results. And what I've found over time by looking at so many systems is that simplicity really, really is the key. And I think that one of the things that one of the many things Stuart has been able to really do is almost catch lightning in a bottle by being able to create this system with us that is very, very simple. The rules are very, very straightforward, and they allow you to follow the rules on a consistent basis, which I feel is just so important. As Stuart said, and we were talking about a little bit earlier, we will be doing our MetaStock Users Conference in October. Feel free to visit his website, or go to metastock.com if you have more questions. If you're going to be stateside, I know we have a lot of Australian viewers right now because it is still a little bit early here. But if you are going to be stateside right around the middle of October, please let us know. We'd love to see you there. As always, we do a little special promotion with Stuart at the end of our webinar. So anyone that registered for this webinar is eligible for this pricing. The trade launch system, which has been, I might add here, it is the #1 selling add-on this year that we have with MetaStock, and we're so happy to have it. Normally the pricing for the add-on is $3.99. For attending this webinar and taking some time out to listen to Stuart and myself speak, we will give you 100 off of that add-on, so the special pricing is $2.99. For all of my non-MetaStock users, we'd be more than happy to discuss a couple of different trial options we have. Feel free to visit metastockaustralia.com or metastock.com/tradingxl. We have a couple of different trials that are available and some special pricing there. Really, if you guys have any questions, myself as well as Stuart will stick around here for a couple of more minutes to answer those questions. But for right now, that's all we have. Thank you so much for taking some time and out of your day and spending it with us this evening or morning, depending on where you're at. Please let us know if you have any questions by contacting Stuart at his website or us at metastock.com. We're always here to help. Thanks again for taking the time, and as always, happy trading.